Let's set the budget aside for a minute, Neelkanth, and let me ask you about how you feel about the markets in the global context this year. Because the year has started on a rocky note. We can see turbulence in the American market very clearly, largely in the technology space. Do you think this year we might see severe headwinds from the global space, which will become much more important than the economic cycle that we're seeing in India? Or do you see the market differently?
No, absolutely. In fact, I couldn't agree more. In fact, what we are seeing now, you see, when the lockdowns were on, the policymakers had to decide on the fly how big a stimulus they had to give, right? So they had to figure out, is $500 billion enough? Is $1 trillion enough? I'm talking about the US, of course. Is $1.5–2 trillion enough? How much should you print? Should it be 60 billion a month? Should it be 200 billion a month? Should it be 500 billion a month? And now that we can see the pandemic in the rearview mirror, and touch wood for that, it is time to calibrate whether the responses were appropriate. And what we see now is that there is a lot of money in the overnight bank markets, not just in India, where of course a lot of it was created by the surplus dollars coming in, the balance of payment surplus, which the RBI had to neutralize. But even in the US and in Europe, so in the US, there is now $1.8–1.9 trillion overnight, which the banks are parking back to the Federal Reserve, which means that this is excess money. Same in Europe. So they already had a big surplus, but that number shot up further to $4 trillion. Japan has been at 4–4.5 for a while. So this suggests that the monetary action was excessive. For almost for many years, I would say, we have forgotten, or at least the markets have forgotten, that high leverage and high interest cost burdens can lead to bankruptcies. And these are questions that have not been asked for quite a while. And now you see, after a long time, that the double B bond yields are starting to go up, and the bond markets are starting to price in some risk. At the same time, on the fiscal side, in the US, retail sales went to 7, 8, 10 standard deviations above normal, which means statistically they shouldn't have happened. And so when you see that large a stimulus, and of course now that they're worrying about inflation, they're very clear that even if growth signs are weaker, and clearly with the Jan employment data, they have another month at least of retaining that hawkish stance, it is very clear that the primary target for policy now is inflation. It's not growth. And as the world recalibrates to that, I think you should expect a lot more of choppiness. If you see oil prices, so while I'm reasonably comfortable that a supply response will occur in most metals, on oil, I'm worried that the supply response may be constrained either by geopolitics or by the shale companies being cash rich but refusing to invest in fresh rigs or new drills. And
right.
What this means is that there is a lot of transfer from the oil producers, or from the oil consumers to the oil producers as oil prices go up. And because the oil producing nations, the surpluses are concentrated in a few nations, it actually becomes a drag on overall growth. So lower oil prices are good for global growth, and higher oil prices, especially when supply is the constraint, are actually bad for global growth. And I think all of these concerns will become front and center over the next few months, and I expect a lot of choppiness in global markets. That should worry us, particularly given that the price to earnings premium that India is trading at right now is close to its highest levels, right? So the PE premium, the range used to be -5 to 35. We were at 38 in September, and then we saw a bit of a correction to 21, 22. And because in January the global markets fell a lot more than we did, that number went up to 33% again. So given how stretched the PE multiples premium is, if the global markets are volatile, I think we'll be volatile as well.